Folks, welcome to this week's macro setup. I'm here with my dear friend Dan Nathan. You can find Dan at Risk Reversal. I'm Guy Adami. You can find me at Guy Adami. Dan and I are both contributors for CNBC. You probably know us from CNBC's Fast Money. And this macro setup is brought to you by our presenting sponsor, Nadex, the premier U.S. exchange for trading binary options, knockouts, and call spreads. Dan Nathan, how are you?
Guy Adami doing pretty well this morning. Lots of things going on this week and lots of things to keep an eye on here. Let's just get into it. Speaker Pelosi set a deadline, a 48-hour deadline that's going to come to pass on what the likelihood is for further fiscal stimulus, working with Treasury Secretary Mnuchin. They seem to be in contact yesterday, I think, when on Monday, when it looked like we weren't going to get a deal, we saw the S&P 500 take a precipitous drop. What was that, a 2% intraday peak to trough decline? At one point, the S&P 500 looked like it was up 10% on the year. We're down now about 7% here. So the clock is ticking on this deal. You know, my sense is this, is that even a deal, some sort of agreement would just be that in name, the idea that money would be flowing through to, those in need of it anytime soon prior to the election is not particularly likely. We can think back to March when the CARES Act passed. It took a while for that money. So to me, it would really just be a market headline. What's your take here? We have a one-year chart of the S&P 500. We've been talking about some of these levels here. What does it mean for the S&P 500? We've had some volatility in this range over the last 2 months. And what are you looking at and what are the levels?
Yeah, well, it's clear that stimulus is the talk of the town. And if you recall a few weeks ago, I think it was a Monday night's show on CNBC's Fast Money, where you and I actually, I wouldn't say it was a heated debate. We had a conversation, though, my view about what the president was trying to do. If you recall that day, and it was the day that the market had a huge sell-off on the back of President Trump saying, you know what, stimulus talks are off. We'll revisit it after I win the election in November. We'll talk about this in January. In the meantime, I want the Senate to focus on the Supreme Court hearings and pushing through our Supreme Court nominee. And the market obviously did not like that. But my point that evening was, and I'll say this again, I think President Trump and the administration is keenly focused on the performance of the stock market. They said from day one of their administration that the U.S. stock market is a report card for how well they're doing. So I think he was willing to sort of put that tweet out there, knowing full well he was probably going to backtrack and say something different. Now, I didn't know it would be 6 hours later that evening, but it doesn't matter. And if you look at really what he said today specifically, he actually wants a bigger deal. And I think that's one of the reasons why you're seeing, the market do, at least as we're taping this morning, reasonably well. I will say this, Dan, I still think when a deal is announced, and I do think there will be a deal announced, I think it will be sell the news event, and we can talk about the levels. The recent high, by the way, when we peaked over 3,500, the first time we did our macro setup, we sort of talked about 34.94 being a logical level of resistance. It actually traded through there, but I do think that's going to be a level of resistance again in terms of where this market stalls out, Dan.
Yeah, so we have the lines right there. The prior high was just below 3,600. You have your 3,400 is that prior high from February, the all-time high, and then you have that bounce level just above 3,200. I think the range is probably set for the next couple of weeks as we head into the election here. But there's a couple other things other than stimulus that I think are really worth talking about that could be drivers. There's been a lot of conversation about the pace of COVID infections rising pretty dramatically. We see some major efforts in Europe being taken to kind of slow the spread again. It feels very much like March and April. And I think it's important to remember for those people saying, well, that's Europe. Europe really led, if you think about where the infections were after China, it was in Europe. And then we were kind of a month behind them. So when you have Ireland and France and the Netherlands imposing a lot of the sorts of lockdowns of restaurants and bars and that sort of thing, again, I think there's a good chance that we will have pressure to that extent over the next few weeks. And why that's important here is what is the pace of the economic recovery right now? We are 6 months past that heavy hit of monetary stimulus that we saw by the Fed. And then when we saw the CARES Act pass, that was in late March, but we really saw the market react in late March, but the money didn't start flowing through until April, and in some cases in May. And we're starting to see really just the kind of lagging effects of that stimulus right now without a redo. We know that the Fed wants to keep the pedal on the metal as far as easy money and monetary stimulus. But to me, those are going to be really important. We know that we have jobless claims Thursday morning pre-opening. That's going to be a big driver. Are there any other areas as far as stimulus and the economic data that you're focused on, other than, before we get to earnings, because this is going to be a big one, and I think should be a big driver for some of the major indices, particularly the Nasdaq 100, which we know there's a handful of stocks that make up about 50% of the weight.
Right. We have some other charts, obviously, we want to talk about, but in terms of what other catalysts this week, and again, we're not a political show on CNBC, and we're trying to stay away from politics here. But the reality is politics has absolutely levered its way into the conversation. And this Thursday evening, I know you know this, is the second debate and probably the last debate between President Trump and candidate Biden. I think that could be fascinating as well in terms of, what it augurs for this election, which is now, I guess, less than 20 days away. It's pretty remarkable that we're within this window of it.
It's actually 2 weeks, big guy. November 3rd.
Thanks.
It's the Tuesday.
You,
it's always the first Tuesday of November, just so you know there.
I actually voted in the first Roosevelt election. I remember like it was yesterday, but I digress. And again, look, you're still talking about, and we're going to talk about the VIX later as well, but it's important in the context of this conversation to mention, as we're taping this right now, the market is up significantly, but the VIX is hanging in there around this 29 level. I think that's telling a story as well. So I look at this chart and I say, that high we made back in August, I don't think we're taking that out anytime soon. Mm-hmm. I think this recent high we saw in early October probably is the peak for a bit of a period of time. And I do think we're going to retest and take a look at the prior all-time high of February. And Dan drew that middle line, which was basically 33.93 or thereabouts. And I think that's going to be your first significant level of support. And I think we're going to see that relatively soon, Dan.
Okay, so just to wrap up that segment right there, as we were talking about the S&P 500, this week we have the debate on Thursday night. We have jobless claims Thursday morning. We have just kind of the rhetoric as it relates to the election and people kind of gaming election outcomes. That's kind of the big story. On the back burner a little bit is corporate earnings. I know that there's a lot of people that don't think they're particularly important at the moment, especially in this kind of zero interest rate environment, especially when we know that if we don't get it this week, fiscal stimulus, we're going to get it sometime in the next couple of months in a big way, which is almost like a put for the market. But what I think is really important is that if you think about, the S&P 500, the Nasdaq, they're made up of stocks, right? And those stocks have earnings, and those earnings should be the major input, right? If you think about the valuation for a broader market. This week, there's a few names that really stick out to me that I think are important. Tuesday after the close, today is Netflix. Then tomorrow after the close, we have Tesla, and then we have Intel. On Thursday after the close. There's a bunch of others. I'm focusing on these because I really want to talk about the NASDAQ. We have a ton to talk about as far as the NASDAQ and into next week. Tesla is interesting to me from a sentiment standpoint. We know that this has become a monster stock with unusually positive sentiment and a monster market cap that a lot of people have a hard time getting their arms around as far as evaluation standpoint. Netflix is always interesting. This one this year was really thought to be a proxy for that kind of stay-at-home thing. Their North American subscribers were declining. The growth rate was declining precipitously. There was a lot of people talking about all the competition coming online, which was going to put pricing pressure on them. Well, they saw the first half of this year a major unsuspected ramp in subscribers. The question now is, are we going to see a deceleration from that ramp, and has the stock priced it in? And then Intel is on the tape this morning selling their NAND flash division. And, that's something that investors wanted to see them kind of get out of. It was too competitive there. So here's three big names, but Nothing compared to what we have next week. We have the F-MAGA complex reporting Facebook, Microsoft, Apple, Google, and Amazon. Those 5 names make up about 50% of the NASDAQ 100. Let's bring up that chart, guy. Do some charting on this one. What are all these names reporting over the next, let's say, 8 trading days saying to you about the potential for a NASDAQ move?
So it's interesting. And, we talked, our first macro setup, we talked about this chart that you just pulled up. And what we both thought would happen basically turned out, and we're not trying to play revisionist history, but it's important. What we said was you have this huge uptrend line. Obviously, the NASDAQ broke that line over the summer. We've had that meaningful low. And we thought, both Dan and I thought, we would retest that uptrend line. It would come in the form of about 12,100 or so. We wouldn't take out the prior high of 12,439. And that's proven to be the case. You've obviously had a bit of a sell-off now. How do I look at this? Earnings are everything. I don't care what anybody says. The foundation of any market is the pillars of earning. And those 4 pillars are earnings, earnings growth, revenue, and revenue growth. And maybe you've seen earnings can be sort of alchemied out, but you haven't seen the commensurate, in my opinion, revenue growth to back up the valuations that the market are seeing. And I look at this chart and I said, we traded back to that uptrend line. We have failed. I think this puts us well in the parameters and well in the crosshairs of basically retesting that support. And it comes in the form of the line that Dan drew, the horizontal line of 11,000 or thereabouts. So I think you're going to see that post the F-MAGA complex. And we're going to talk about Apple because I think obviously that's probably the most important one. My view on Apple real quick in the context of this NASDAQ chart, because I think it's in a lot of ways a proxy. Think about last quarter when Apple reported, Dan. They gave you basically the stock split, which was the catalyst for that huge move to the upside. They probably pulled forward a lot of demand. You obviously just had the Apple day. So my question to you is, what arrows do they have left in their quiver when they report this quarter in basically, I think, a week from today? So 9 days from today.
Yeah, so on October 29th, really interestingly, we're going to have Facebook, Apple, Google, and Amazon all reporting on the same day. One of the reasons I want to pull up this Apple chart and kind of focus on this, obviously we're focused on the broader indices, that sort of thing, but this one might be a tell. If you look at this, it had that massive ramp right after its earnings in late July. I think the stock went from 96 to 138. It had that huge reversal on September 2nd. That was the all-time high in the S&P and the NASDAQ there. And it really never came close again on this ramp. We had that weird day last week where Apple was up 6% prior to that iPhone announcement. And now we're approaching that uptrend from the March lows. And so what's interesting to me about this is that if Apple were to break that uptrend, now that all the news is out about the iPhones and the products in general, and now we're just waiting for earnings, that just kind of makes it that much more important. You have some support down at that $100 level, and then obviously a gap fill to the 96 is where the stock was trading prior to its earnings. I'll just make one point about their forward guidance. You said, did they pull forward a lot of good news with that stock split and the guidance in general? Well, let me tell you this. They announced in September this very low-end SE phone, okay? And then they had this event last week where they announced 4 5G phones, okay? But here's the thing. They have the 12 and the high-end 12 Pro. They have 2 different sizes of each of them. They're staggering the release of those phones. They're doing the 12 Pro is one size is coming out next week and one size of the 12. And then on November 6th for a November 13th delivery is another different size of each one of them. That's weird, man. I'm just telling you that's weird, and it could really mess with kind of their guidance for the current quarter. And then the other point is that they're relying heavily on the messaging from AT&T, Verizon, and T-Mobile Sprint to really sell the case that 5G is here and it's national, and there's a reason to spend $1,000 or more to upgrade to a 5G phone. I'm not certain the service is here. So this is a really important stock to me, because if people don't upgrade, and some of the early indications, and we're going to have earnings next week from AT&T and Verizon, are that their guidance doesn't suggest there's going to be a big upgrade cycle. Apple's going to break that lows. It's going to, or break that uptrend. It's going to take the NASDAQ with it. So that's why we're focused on that one single stock chart here. So that's really important. God, let's move to, there's a name reporting Friday morning, and I want to get your take on American Express. We're not going to, talk about the technicals here. This is more thematic because it's really going to help us kind of talk about the Dow Jones Industrial Average. We know that there's 30 stocks in there. Apple's in it. American Express is in it. Intel, which we've already talked about, is in it. Procter and Gamble that reported this morning. What's your take on some of these names, less tech-centric, as we've kind of broadened it out? We know that we've had a lot of the bank earnings. What is American Express going to say to you Friday morning about their guidance? It's obviously been an underperformer.
So here's something that, I've learned this over the years, and this is something I've tried to say, and maybe I've said it well on occasions and poorly on occasions, but I want to be clear. What I've learned being with the network now, better part of 15 years, never underestimate the U.S. consumers' want to spend. But don't confuse that with their ability to spend or whether they should be spending or not. What I've learned is as long as there's optimism, consumer optimism, regardless of the environment, the U.S. consumer will spend. And I think that's an important understanding. And it's somewhat nuanced, but it is important. What does it all mean? Well, just let me say one other thing. We talked about this at Fast Money on Monday, how over the weekend, for the first time since March, TSA cleared, I think, 1 million people at U.S. airports. And that sounds encouraging. So let's just try to break these couple things down. This is my contention. That would be a great number if all of a sudden magically this virus went away and we had a vaccine and people were traveling again for the right reasons. I happen to think it's more a function of people being complacent, lazy, or antsy, or some amalgamation of the three that led to that number. That sort of scares me. The other side of the coin is, remember, American Express is different than MasterCard and Visa in that American Express takes credit risk. MasterCard and Visa are just processing companies. That's very important to understand, because what I think you're going to see along with the major banks is American Express is going to talk about write-offs and credit and their risks associated with this environment that we find ourselves in. So although American Express is a premier company, I think you're going to see some headwinds in terms of what they say about the consumer. And oh, by the way, I think you're going to start to see analysts going either cautious on the stock or sort of having a market perform instead of the outperform that it's historically traded at.
Yeah, and it's not just the consumer. Actually, it's travel and it's corporate. I mean, they have a huge corporate business, right? And so when you think about that, I just talk to anybody that that used to be on a plane 2-3 times a month, for business and staying in hotels and using car services, booking them on their American Express and using their kind of high margin ish. Travel services. They're not doing it right now. They haven't been doing it for 9 months. Before we get to the chart of the Dow Jones, I want to bring up this tweet from David Rosenberg, who's a pretty famed economist, or infamous maybe, but I really like David's work. He's kind of always labeled as a perma bear, but I always think that it's pretty useful when someone's trying to pick apart the universal bear thesis. Yesterday, he tweeted this, and really this is in response to all the conversation about the need for further fiscal stimulus, but also looking at last week's retail sales number, which was really good, and people were taking that as a really bullish sign. His tweet said, guess what the biggest stimulus was for the retail sales report? The other 60% of the spending pie. Cutbacks in education, health, domestic services, travel, and recreation of all sorts have freed up $700 billion since February. That's 2 years worth of retail sales growth right there. So to me, what I thought was really interesting about this is highlighting the fact that, yes, the consumer's balance sheet has gotten a lot better here, despite the fact that we have 20-30 million Americans on some form of unemployment assistance. But they've really it's kind of stealing from Peter to pay Paul, right? We pulled forward a lot of that demand. And once things get normalized, their balance sheets might not be in good shape to spend the way they would. I thought that was really interesting. Do you want to have a quick comment on that? I know you kind of mentioned the whole point about the consumers want to spend, but that's just something that people are not focused on. It really has the potential to put our consumer-led economy in a malaise in 2021 if the fiscal stimulus is just keeping things afloat once we get it.
Well, that's really all it's doing if you think about it. I mean, and this is an economy, U.S. economy is 73% driven by the consumer, by people spending on things and people buying things. Well, I think over the last 7 or 8 months, I understand that people want to get out there, but I also think there might be a fundamental change in our economy, and this is just my opinion, in so much as people learn to do more with less, and maybe you're not going to see the free spending that we've seen over the last decade or so. And maybe people realize what's become important to them, it's what's not become important. And in 8 or 9 months, you might have fundamentally changed the way people behave. And that's problematic for an economy that is driven by the consumer. And quickly, you're talking about, and I think Rosie might have mentioned this in another tweet, GDP is not going anywhere. As a matter of fact, if anything, it's trending lower. In the meantime, you have a market that's been trending higher. So, without getting into the wonkiness, the one metric that Warren Buffett looks at when he's evaluating the market is market cap of the S&P 500 over GDP. And we're at about 175 to 180% or so. And that is historically a huge number in terms of where Mr. Buffett decides the market is expensive. I mean, he looks at, 140 to 145% at the under end of the spectrum, upper end of the spectrum. We're at about 180%. Just think about that for a minute. And oh, by the way, the numerator is getting higher and the denominator is getting lower. And you can do that math, Dan, because I know although you went to Syracuse, you did some time at the University of Pennsylvania, that only increases that percentage number, which is a scary thought is before we get into this Dow Jones chart.
Yeah, so let's talk about the Dow Jones for 1 second here. You and I don't quote the Dow Jones industrial average, which is really not an industrial average. If you think about it, it's 30 stocks, and we know it's price weighted. But what is interesting about it is an actively traded sort of instrument, and that is interesting to me. This chart has a very different look and feel than the S&P 500. You see there the prior high. It did not make a new high all year long. It looks like a pretty constructive chart if you think about it from that standpoint. The 200-day moving average there in yellow seems to be pretty good support down there. And we know what the breakout level, what's your take here? And I just want to make one other point. We talked about this being a price weighted stock. We know that Apple split, might have had a little different effect on this one. But, it looks a lot like the equal weight S&P 500 chart, which means that, all the stocks in the 500 are equally weighted. So the heavily skewed regular weighted to Apple, Amazon, Microsoft, Google, that sort of thing. The S&P regular way has not made a new high. It's actually trading at the exact same level it was almost a year ago. So how do you think about that in a way? Obviously, we know some of those big names are doing all the heavy lifting, but what is it saying about the Dow Jones Industrial Average and the potential for some of the laggards in that index to play some catch up, maybe after the election, and break out to new highs?
So as a trader here, trying to establish, how I'm going to position myself and how I'm going to trade around this, I look at this and say to myself, okay, we made a high, an all-time high, I think on February 12th of 29,600 or right around there, give or take. We obviously traded back to it almost, and Dan can pull that up. I think it was early August or so.
Yep.
I look at this and I say to myself, okay, at what point, if we see a sell-off in the Dow Jones, at what level have I now put in a double top? Because at a certain point, that's the conversation you start to have. Maybe it's 27,500. Maybe it's sort of that island between the middle of May and early June. Again, Dan can we can look at that and you can see the exact island I'm talking about. But in your head as a trader, you have to say, okay, if the Dow breaks X on the downside, we have a significant double top, and we're absolutely going to test that 200-day moving average of 26,500. That's how I look at this. By the way, that's what I think is going to happen. And, I'm not trying to be dogmatic here. I'm trying to be just trying to read the tea leaves. But I do think that we have put in a double top. And I do think we're going to test that 26,258 level or whatever the 200-day moving average is at the time. So that's how I look at this, and that's how I evaluate this, Dan.
All right, let's look at the VIX real quickly. You've been pretty adamant about the fact that, when we've had these scenarios where we've had a rising VIX and a rising stock market, that's set up for some of these sell-offs that we've seen over the last few months, which haven't, they've been rare, no doubt about it, but they've really had to do with, the pace of the economic recovery, what the enthusiasm is about vaccines and therapies for the virus, and then obviously stimulus. So here we have a situation where The VIX has had, obviously great support since breaking out in February at 20. It's been in this little uptrend over the since the beginning of September. We saw that spike when the S&P 500 topped out here. So now we're approaching that downtrend from the SEP highs. What is the VIX telling you right here, and what should our viewers be focused on as we are fully expecting a volatile period over the next couple of weeks into and out of the election?
Yeah, you think about this, and again, people look at the VIX in different ways, and Dan looks at it one way, and Dan will speak to, the VIX is not a perfect instrument, and I totally get it. And I'm not suggesting it's somewhat predictive, but what I will tell you is a couple different things. The VIX can tell a story, and we talked about this on our first macro setup, and I'm going to talk about it again now. There have been periods of time where you've seen the market rally and the VIX rally, and that's proven to be an area where the market was poised to reverse and go lower. Conversely, and we've seen this recently, you've seen an environment where the market has sold off and the VIX has sold off, and that's proven to be an area where the market's poised to reverse and go higher. Here we are with a VIX around 29 or thereabouts. My suggestion to you is we're about to break out of this pennant formation to the upside. I don't know if we're going to get back to 40, but I do think there's a very good chance we see it back in the mid-30s. And that's going to lead to, in my opinion, a pretty precipitous drop. And we talked about all the other charts prior to this, but I look at this and say, the VIX is setting up for another move to the upside, and that move to the upside in the VIX is going to correspond with a pretty meaningful sell-off in the S&P, Dow Jones, and the Nasdaq. And quickly, think about this just theoretically. You're talking about a VIX at, let's just call it 29 for sake of argument. When the S&P 500 made an all-time high the first time back in February, the VIX was trading around 14. Here we have the S&P 500 effectively within 70 handles or so of that same level, and you have a VIX that's twice that. To me, that's telling you something. The VIX clearly sees some I think it sees some volatility ahead in terms of the market trading lower. And I think it's telling you that we're going to break through this pennant formation, probably take a look at 35, and that's going to coincide with a drop in the S&P, Dow Jones, and the Nasdaq. And maybe that comes in the form of Apple earnings next week. Maybe that provides the catalyst, Dan.
Yeah, I think we've kind of tied a lot of these topics together. If you think about it, why do we focus so much on the FMAGA? They are almost 25% of the S&P 500, and they're 50% of the Nasdaq 100. And if they all go in the same direction together, that's going to have a substantial impact. We know that there's $3 or $4 trillion of those companies reporting on October 29th. If they were all to go down, let's say 5% or go up 5%, that's going to have a substantial move on either of the directions. I guess with the VIX, what's going on, this makes perfect sense right here. If you're just seeing hedging in front of the election, this is obviously one of the big unknowns. I think over the last few weeks, the market's got a little more comfortable with the fact that we're not likely to have a contested election if the Democrats win the Senate, flip it in a big way, and also there's big margins of victory for the White House. Let's go and away from the U.S. stock market, away from U.S. risk assets. There's another major macro event going on, and this feels like it's been going on as long as we've been talking about this populist movement, Trump as the president here, and this actually preceded all that. This was Brexit, the vote in mid-June, and they're still talking about this thing. They're still trying to negotiate a trade deal on the way out. So the big story is, the EU has basically given in to the UK and said, let's negotiate a deal. It seems like the UK or the British Prime Minister is being difficult on that. What does a no-deal Brexit mean for the British pound? We have a couple charts here. Let's pull up the 1 year. This is obviously the way to kind of play this, and there's some pretty interesting levels I think you want to speak to.
Well, you have a pretty major top, as you outlined, Dan, around this 135 level. I mean, that's clear as can be. And it's also within the context of what's been a pretty significant uptrend since obviously the March sell-off in the equity markets globally, and then probably what was a flight to quality in the U.S. dollar. What does it mean to me? Well, you're playing against a trend line. And at a certain point, you have to have an opinion. You could trade against that trend line, or you can say to yourself, you know what? The tea leaves are such, the environment is such that maybe we do see a hard Brexit, and you have to try to figure out what the next level of support. And I understand the currencies are a completely different animal, But I look at this and say we've been trading against that trend line for quite some time now. You have a major short-term double top in place around 135. I look at this and say to myself, you know what? 125 is absolutely in the crosshairs. And quite frankly, 123 and a half or so is probably your next huge major level of support. So, you know, that's what I'm looking for here. And if I'm wrong, I think you're going to know you're wrong pretty quickly. And you're going to probably know you're wrong if you see a spike over, let's call it 131. I just don't see that happening. You're basically holding this trend line. You hold it until you don't. And then you see how quickly things can go pear-shaped, not only in equities, but in currencies as well, Dan.
Yeah, so I would just say this is that, you know, that trend line, the uptrend is pretty important. And that double top is also important. If you had a deal that people felt good about, you could have a move back up to that prior high there, you know, the double top, which is, like you said, around 135. You could use a stop at that uptrend if you were looking to be optimistic about that. We have a 5-year chart real quickly, and you see that from, you know, I mean, this is upper left, bottom right, you know,
Right.
and we kind of held that 120-ish or 115-ish to 120 level there. That just gives you kind of some context of what a longer term move could be. If things were to go well in the favor of the pound and you have a substantial breakout of a long-term uptrend, then all bets are off on that one. So I just think it's important to think about it from each level. All right, we just wanted to kind of wrap that one up. That's kind of an interesting take here. Take us out, Guy Adami. You know, a lot going on this week.
I mean,
and next week.
it's like, it's a blink of an eye and this thing is over. I've enjoyed this. You know, again, we're trying to give you levels, things to trade against, things to look for. You know, what are the catalysts going forward? We'll obviously be back with you next week, but both Dan and I, Dan at Risk Reversal, Nadex at Nadex on Twitter. I'm at Guy Adami on Twitter. I want to thank our presenting sponsor, Nadex, the premier U.S. exchange for trading binary options, knockouts, and call spreads. Dan, Nathan, always thank you.
See ya. Thanks, bud.